Hello, everyone. Welcome back to another installment of the Lunch and Learn webinar series. My name is Mayur Thaker. I am an equity strategist here at Zacks Investment Research, and today we are unpacking the trade war that was just waged as of last week, April 2nd, dubbed Liberation Day by Trump. And what I wanted to spend is a little bit of time on what I think is actually happening and what I believe is the best way to trade it. So let's get started on that. Lots to unpack and uncover here. So Trump, as we all know at this point, on April 2nd, unveiled a slew of tariffs and he billed it Liberation Day. And on that day, what they did is they announced a whole host of reciprocal tariffs, as what they called it, which included tariffs on dozens and dozens of countries, including our biggest trading partners, China, the European Union, and many other countries included in that, including India, others as well. So there's a couple of levels of tariffs that I just wanted to clarify so that everybody understands exactly what was announced. There was either a reciprocal tariff, which in their view is an estimation of both tariffs and non-tariff trade barriers. Okay, so countries have tariffs, but then they also have other trade barriers that aren't technically considered tariffs. The most common of which is a VAT tax. Europe does this. Other countries do this as well, which is basically a sales tax added on top of the import tariff. So this is known by any European if you're watching, if you try to purchase a product from America, there's usually a 25% tax that's applied. But that tax doesn't exist on our side. If we, buy a product or service from Europe, we as in Americans, if we buy a product or service from Europe, we only have our regular sales tax that's applied at the local level. And that's equal to basically anything that you buy, whether it's domestic or international. There is some import tariff, but that is not counted in terms of the sales tax that we pay. So, Trump basically in that presentation listed out all of the different tariffs that foreign countries charge to U.S. exports into their countries. And that rate that they used is a combination of both the import tariff as well as other trade barriers, especially the VAT tax, right? So that is the rates that they charge to U.S. companies or U.S. Exports, according to the Trump administration. And so what Trump announced was reciprocal tariffs, and this is kind of a misnomer and really not sure why they called it reciprocal tariffs because the reciprocal tariff which they announced is basically the ratio of the trade deficit that we have with that country divided by the level of imports that we have from that country. So it's basically the trade imbalance that exists between the two countries. And he used that trade imbalance to determine the tariff rate. So there's a lot of debate back and forth about why they did this, whether it's a good idea or not. I'm not here to tell you whether it's a good idea or not. That's completely up to you. I don't want to get into the politics of it. Just wanted to report the information about it. So the reciprocal tariffs are basically the size of the trade imbalance that we have with each country. And President Trump basically said that this rate is basically a fair rate to be charging these foreign countries because they charge us significantly higher total trade barrier. So that's the total amount, including the tariff and the other non-tariff trade barriers like VAT taxes. And to a certain extent, that's true. We've had, both President Trump over the years, as well as many prominent Democrats have talked about this over the years. So there is some level of truth to the fact that, foreign countries do charge higher rates on American exports than we charge their exports into the US. That is true, and many Democrats, including Chuck Schumer, Bernie Sanders, even President Obama have talked about this before in the past. And so, there is some level of consensus, even if they don't show it in political rhetoric right now. There is some consensus when each party is in charge. They do and have brought up this issue before. So there is some level of truth to what President Trump is talking about with regards to the unevenness of trade terms with foreign countries. So that's why on Liberation Day, he announced these reciprocal tariffs, which basically assigns a tariff rate based on the size of the trade imbalance that we have with each country, or a 10% minimum import tariff. So if the reciprocal tariff amounts to something less than 10%, then the 10% minimum import tariff takes hold. So it's the greater of the two, is what they announced. And this is on top of Section 301 and Section 321. That's the de minimis tariffs that have already been in place for many years now. This was announced in the first term, and the Biden administration basically preserved most, if not all, of those new tariffs on China and other countries that the Trump administration rolled out in his first term in 2017, 2018. And so the sum total of all these tariffs have taken the cumulative tariff on many products from China well above 100% now. I believe now the final rate is at something like 125%, or 135%. I'm not sure exactly what the number is exactly, but it's a ridiculous number at this point. However, what I would like to say about this is I personally am of the belief, this is just an opinion of mine, is to not fear the tariff, because the tariffs as they were unveiled on Liberation Day, meaning all those reciprocal tariffs that were announced, I don't believe they're going to stand. I believe that this is, Trump in his own way trying to negotiate better trading terms with foreign countries, or to encourage companies to circumvent the tariff by directly investing in the United States for manufacturing and hiring. So I really don't believe that these tariffs, as unveiled, are going to stand. They will be negotiated down. In many cases, they will be circumvented entirely because in certain cases, it will be more beneficial and economical to directly invest in the United States. And in that case, there is no tariff, right? Even if the tariff rate is 50%, if you directly invest in the US, there is no tariff. If production shifts and if supply chains shift meaningfully enough to the US domestic, then there is no tariff at that point. Even at the margin, let's say, for example, you are a completely foreign producer and you source all your supplies from foreign sources. If you simply shift production to the US and keep your foreign suppliers, the effective tariff is significantly reduced, right? Because a significant portion of your revenue is now coming from domestic production, and it's only the portion that came from overseas that gets tariffed at that high rate. So at the margin, this will actually lead to greater domestic direct investment. That's my opinion. So again, my opinion overall is that the end result of the Trump trade wars will be a hybrid of tariffs and free trade and everything in between as well. They won't stand as announced last week on April 2nd. It will be negotiated down. So we're going to have a four-tiered approach, kind of like a cascading approach, a cascade of levels that we ultimately end up with. Number one, which is the highest level, the highest sort of cascade or tier, which is high tariffs on countries that refuse to come to a compromise. That could be China, that could be others. But any country that does not come to some compromise, even if it's a token compromise, the high tariffs, as announced on April 2nd, will stand. But then for the countries that do negotiate a lower trade barrier, total trade barrier, so that includes the tariff rate plus any VAT taxes that they charge, those countries will get a reduced tariff. So the shock and awe that was presented on April 2nd will end up being something much more tame. And then a further tier, the third tier, which is even more attractive, would be lower tariffs or low tariffs on countries who similarly slash their total trade barriers to zero or close to zero. And then you'll have the ultimate tier, which are countries, specifically Canada and Mexico. We already have a free trade agreement under the USMCA. So all items that are USMCA compliant are going to remain, tariff free, trade barrier free, as long, along with other countries that do come to the negotiating table and negotiate down their rates and VAT taxes significantly enough for the Trump administration to say, okay, well, we'll also slash your tariffs to zero as well. So there's going to be some combination of these four tiers, as I call it, with regards to trade. So the numbers that were revealed on April 2nd, they're not going to stand. So the long run result, if this happens, if these four tiers end up happening, I think the long run result will be positive if they happen. If this is how it turns out to be, if the tariffs on April 2nd do not stand, if they are negotiated lower on many important trading partners, if they are slashed to close to zero on many others who do the same thing for us, and if some countries actually get a free trade agreement with us, um, the end result will be very positive, because it achieves, well, I wrote two things. It's actually three things. Brings certain jobs back to the US. Okay, because certain countries, depending on the industry and depending on the level of profitability, so every company will be different. They all have different unit economics. And so for certain companies and countries, it will actually be more economical to relocate production and or supply chains back to the US. At the margin, this is going to have a positive effect on direct investment in the US and therefore jobs in the US. Um, Tariffs at the margin encourage direct investment, right? At the margin, it encourages direct investment. Or number two, raises substantial revenue for the government. This is definitely going to happen. I think this is actually a general consensus. This shouldn't be controversial. If you do put up, trade tariffs, then that will raise revenue. In the meantime, while companies, figure out, their next best move, either direct investment in the U.S. or to end doing business in the U.S. entirely. That could be a negative. But overall, it will raise substantial revenue for the government, which then opens a door for further corporate and income tax reductions in the future, right? Remember, this is the other goal that the Trump administration is working on, which is the DOGE initiative, right? Department of Government Efficiency. If they do cut, some spending, um, and if they raise revenue from tariffs, then that would be very negative for the deficit, meaning the deficit will be trimmed quite significantly. Um, and if the deficit can be narrowed to basically zero, possibly a budget surplus in 3 or 4 years, that opens up the door to, to corporate and income tax reductions in the future. And if you think about it, if you slash the corporate income tax rate, that would actually go a long way to actually accelerate what the tariffs are designed to do in the first place, which is to encourage and accelerate direct investment and hiring in the US. So if you actually provide a double incentive, a tariff in addition to a benefit, an economic benefit of doing business in the US, which is a lowered corporate tax rate, that would have a double sort of boost. It would be a dual engine in a way of direct investment and jobs and hiring in the U.S. Again, just my opinion. This is still speculation. We would need, Congress to work on tax reform or any further tax reductions. But I believe that is on the agenda for the Trump administration is to do that. And then lastly, and this is a really big one, especially if we have, much better trade deals with foreign countries. What that does is that it opens up new geographic markets. Because remember, if let's say if everybody gets to this fourth tier, right? Everybody goes to this fourth tier where everyone slashes their tariffs and trade barriers to zero. Or let's say they go to either the third tier or the fourth tier. That would lead to a global sort of race to the bottom when it comes to trade barriers. So in that case, it wouldn't do much at all to bring certain jobs back to the US. Why, right? Because if everyone takes their tariffs down, then at the margin, um, it would not actually generate significant manufacturing or other jobs back to the US. Everybody would remain where they are. But what it would do on a positive sense would be number three, it opens up new geographic markets for US companies to sell into. So if Europe, China, and Japan and India significantly slash their trade barriers with the US, then suddenly we have new markets where American autos, for example, and other industries, steel and aluminum, agriculture, these are new markets where, very important industries in the US can start selling into with less artificial competition from governments. So that would be bullish for corporate earnings. So again, any combination of these, you know, tier two, three, and four, but even tier one, I believe the long run result, will be positive in my view. However, the long-term gain is going to require some short-term pain. And the big thing that's compounding this problem is valuation risk. This is something I've been talking about in many of my webinars in the past. Valuations are not our friend right now. This is Robert Shiller's CAPE yield spread framework of thinking. This is one of my favorite equity valuation models, and you can see that it's had quite a impressive track record at predicting forward 10-year excess returns. So this is in the blue line here. This tells you the CAPE yield spread. So basically, the CAPE yield is the inverse of the PE multiple. So that's the earnings over price rather than price to earnings. So that gives you a yield. Also, the earnings are calculated in a different way. This is using long run 10-year average real earnings per share. Okay, so 10-year average real earnings per share. That's the numerator. Denominator is price. So that gives you a yield. And then what Professor Robert Shiller does is subtract the 10-year yield at the time. That gives you the excess CAPE yield. And that's what's plotted in the blue line. As you can see here, whenever the excess CAPE yield gets low, right? Whenever this blue line gets low, right? Below zero especially, but anywhere close to zero, you can see that the forward 10-year returns have been very, very subpar, in some cases negative for the next 10 years. So you can see that valuations got really stretched in 1929, 1930. That compounded the size of the market decline because we transitioned from a bull market with very bull market PE multiples to a long and prolonged recession. So the market re-rates on two measures, on two fronts, earnings being lower and the PE multiple being lower. So that makes the drawdown especially painful. You can see here that every time again, whenever, these yields get too low, when it gets too close to zero, forward returns are not very nice. Yeah, we saw that again in 1970. We saw it back here in 1930. We saw it again in 40, I believe, or 1937. I think it is something like that. We got it again in 2000. That was the dot-com peak. You can see that forward returns were really nasty for the next 10 years. And we're not as bad as we were in the dot-com peak. We're also not as bad as we were in the 1929, 1930 peak. But we're not looking great either. So you can expect forward returns to be valuations to be a headwind, because we have too much bullishness baked in as we exited 2024. So again, this is basically an equity risk premium, a version of the equity risk premium. Very important concept in finance. This can be estimated using Robert Shiller's Cape yield spread, as we just saw, or we also do this here at Zacks, the Zacks equity risk premium. We calculate this internally as well using a different methodology, but it's very interesting that despite using two very different methodologies, both both of these equity risk premia reached 23-year lows heading into this trade war. Um, that means that there's too much bullishness that's priced into stocks heading into the year. So I believe that valuation is going to be the number one headwind for market returns, because we were just priced for perfection when earnings results are going to be highly uncertain for the foreseeable future. Now, that being said, estimate revisions are still quite tame. Um, you can see that analysts are getting a little cautious, but the size of the revision down has not been that bad. We're only down about 2%, 2.2% from last year. And most of that really just started getting revised down as we entered December and entered the new year into 2025. So even after a week of time where analysts had enough time, at least a week to digest what was unveiled on Liberation Day, the estimates being revised down, still very tame. Not a lot, though it is little. It is a little bit, so this could escalate. But so far, the size, the extent of the revision is not, very concerning to me at least. And this is for next year. This is fiscal year 2026. Estimates have certainly been revised down. The trend is not looking good. But again, versus where we were a year ago, basically flat. Really no change from the fiscal year 2026 expectation from a year ago. So again, earnings are still looking to be resilient. Not much downward earnings estimate revisions just yet. Um, but even if earnings come in decent, my thesis is that valuation multiples are unlikely to return to the peak 22, 23 times that we got as we exited 2024, right? The market reached a 23 forward PE multiple on bullish earnings expectations late last year as we ended 2024. I don't think that we're getting back to a PE multiple that high anytime soon. Investors are going to require a greater premium to compensate for the trade uncertainty, right? And what does that mean? Lower PE multiples. Now, some of the bullish things, the ISM manufacturing has been on a good trend. Remember, this series has been bearish for as long as we can remember, right? And this is one of the reasons why I was calling for a recession in 2024. Actually, my theory was a recession by Q4 of 2023. That never happened. We didn't get one in 2024 either. But now look what's happening. ISM manufacturing is now hitting higher highs and higher lows. This was actually in contraction for 26 out of 27 months. 26 months of contraction out of 27. And now, just this year, we got back-to-back expansionary readings. So manufacturing might actually be in the process of starting a cyclical recovery after being in a deep contraction for 2+ years. And this is very bullish for S&P earnings because ISM manufacturing PMI has a 77% leading correlation coefficient with S&P 500 cyclicals. As you can see on this chart, I have the S&P 500 forward earnings growth expectations, as well as the Zacks cyclical proxy. These are a collection of cyclical companies. These are basically companies that belong to transportation, retail, consumer discretionary, and industrials. These are very important sectors that I watch because they are leading indicators to overall earnings. Are we, these companies enter contraction in advance of the broader S&P 500. Um, and lo and behold, these companies are now, back into earnings growth mode after spending 2 years in contraction. And so that's why it's very important that ISM manufacturing PMI is starting to move higher. So if manufacturing sustains this recovery, I think we could be again at the very early stages of a cyclical earnings recovery for those very critical sectors, transportation, retail, consumer discretionary industrials. That would significantly ease the burden on the Mag 7 carrying the market, right? Because that's basically what's been happening these past 2 years. In fact, almost all earnings growth in 2023 and a significant majority of earnings growth in 2024 came from just the Mag 7. That is not a bullish sort of underlying fundamentals of the market. We can't be showing growth just based off of seven super companies. We want to see greater breadth, a wider net being cast of companies doing well together. So we could be at the very early stages of that happening. I'm seeing very positive trends in that sense, and I will be sure to keep reporting that, to you on every one of these types of webinars that I have here. On to jobs. Here's another very bullish thing. Look at what's been going on with the jobs picture. Here I have a breakdown of government payrolls versus true private payroll growth. This has been one of my big concerns, as you can see here, the black line measures the true private sector in terms of the job growth that they're reporting from non-farm payrolls. And the blue line represents government payrolls. And by government, I aggregate between government, education, and healthcare together because they kind of have a direct correlation with one another since, education and healthcare directly receive funding from the government. And because they are non-cyclical sectors, like government, I group them all into one category and then everybody else in a separate category, which I call true private payrolls. And it's important to distinguish those two because as you can see, the majority of cyclicality, the majority of the noise when it comes to recessions, right? The business cycle plays out in that portion of the job market, not so much the government, healthcare, and education portion of the job market. Because as you can see, with a very brief exception, those three sectors are always expanding jobs. They're always expanding their headcount. So I like to remove that to help look at the true picture of the jobs situation. And as you can see here, it actually entered contraction in 2024. And that's what got me very nervous. That's one of the reasons why I was calling for recession. But look what happened in just these last 3 months. Private payrolls are now in expansion. Again, not by much. We would like to see this number reach 2 to 3% on a year-over-year basis. This is a monthly series. I would love to see this number get back to 2 to 3%. That's where we are on average. It'd be ideal if we got to 5%. That'd be beautiful. But even if we got to 2 to 3%, that is where we typically are during healthy bull market expansions. And this is a very good trend to see. And we're just getting started here. Let's see if this can continue. And here you can see that the government payrolls, which got uncomfortably high, we don't want to see too much of job growth coming from government. That's not what characterizes a strong and healthy economy. And yet, over the last 12 months, during 2024, you know, all jobs in the US, meaning more than 100% of total non-farm payroll growth came from those three government sectors, government, healthcare, and education. That is not a healthy economy. That's not a healthy jobs picture. We don't want to be excessively dependent on government, healthcare, or education for jobs. We want everybody else to contribute, industrials, manufacturing, retail, um, trucking, wholesale, those types of jobs. And that is what has finally started picking up. So employment overall continues very encouraging trends through March. We just got that number last week, um, or 2 weeks ago, I should say. So household survey also at 3-year highs after a long period of stagnation. After a long period of stagnation, this was another reason why I was very, very concerned. Household survey of employment was actually in contraction briefly and has been stagnant overall for 3 years. But now it broke out into 3-year highs after a long period of stagnation. That is very, very, very bullish to see. Meanwhile, permanent job losers, that's been stagnating now for 6 months. After triggering a recession threshold, again, that got me very nervous. But ever since that happened, nothing has happened. It's gone nowhere. So again, that, reduces the likelihood that we are in recession or are heading towards a recession. Number three, private sector hiring accelerates while government sector hiring decelerates. That's what we just saw. And then, of course, leading cyclical industries. This is another methodology that I use that basically I went through the dozens and dozens of different industries that get reported every month. And I have identified 6 specific industries that begin hiring before everybody else starts hiring, and they start laying off before everyone else starts laying off. They are leading indicators to recessions. And these cyclical industries, plastics, trucking, administrative jobs, temp jobs, these are, among the 6 industries that I have found that have very important, high value, high signal, leading, they are together a leading economic indicator, and they are now hiring, and that hiring has been accelerating these last 3 months. So again, employment trends are very, very encouraging. So that's why I just can't assign a high probability of recession when leading indicators of corporate earnings, which is ISM manufacturing, is just what we just saw, and jobs, right? Cyclical employment are both moving higher. So there are some strong fundamentals right now, but because of valuations getting, to exaggerated levels, heading into this volatile period, I remain bearish US stocks. Valuations are too high, and I believe we are in a period of volatility because of trade uncertainty. And this is a view that I communicated in my weekly column. If you haven't been following, or if you're not aware, I write a weekly column titled The Weekly Market Analysis. And for the last 7 to 8 weeks, I've been saying that if we get a weekly close below 56.75 on the S&P 500, then the market is a sell. And if you want to know where this report is, I'll show you right now through the Zacks research system. If you have access to that software, you want to just click on research at the top bar, go to market, and then go to the market analysis weekly. That's the report that I write, and I share these thoughts and buy and sell levels every single week. And then if you have advisor tools, it's just under the Zacks research tab. Go under market, that first option there, and it is the market analysis weekly. So we triggered that sell threshold that I shared with everybody on that report on Friday, March 14th. And on that day, the market closed at 56.38. So that officially triggered that sell, threshold. And if you listen to that, if you followed it, you're, sitting really pretty right now because the market obviously is a lot lower than that level now. And since then, I recommended remaining out of U.S. stocks and being positioned defensively, right, with the Zacks earnings certain proxy. That is the defensive, high quality portfolio that I directly manage here at Zacks. And also to pair that with short dated US Treasuries, you can get exposure to that through the SHY, the SHY ETF, or the JPST, that's the JP Morgan short-term income fund. And then, of course, I also provide levels to buy back. So in case the market does rally back, in case I'm wrong and we don't head too much lower, then the stop buy level for the S&P 500 is at 55, 59.59. That is as of today, April 11th. That is subject to change. So I recommend everybody read my weekly market analysis report for updates to this level. I publish this every Monday around 4 p.m. Eastern. So if you just go back to to access the report through either ZRS or Zacks Advisor tools shortly after 4 p.m. Sometimes it takes up to 4:30. So just check in around that time every Monday, and you will get an update on all of my thoughts and opinions on what's going on, as well as these critical buy and sell recommendations. So the downside may get ugly for the time being, but again, this is why we designed the Zacks Earnings Certain proxy. These are recession resistant, durable, moat protected, low volatility, steady compounders. These are companies that are above macroeconomic volatility because they make things or they provide services that are critical needs, not wants, but needs. Novo Nordisk, Mettler Toledo, American Tower, Intercontinental Exchange, Amgen, 3M. These are time-tested, battle-tested companies, and they've been through every economic downturn imaginable for the last 30 years. And they have, withstood those periods of volatility with almost no, issues, with almost nothing interrupting their fundamental business. And as you can see here, this is a chart of the orange dotted line, which tells you their earnings growth over time. So you can see through recessions, absolutely nothing. They're very rock solid, very steady companies. They compound in all environments, bullish or bearish. And so this is the portfolio that we have assembled. Again, a collection of 66 of the highest quality companies, companies with earnings durability, companies with high returns on invested capital, companies with substantial free cash flow, and ultimately companies with a durable moat around the business. So again, overall, this is what the aggregate portfolio looks like. It's built for long-term durability, as you can see there. The earnings compound in all environments. So that is my takeaway here. Stay tuned for significantly further updates. Hang in there. I think you'll do fine. I think the markets will be fine in the long run. In the short run, just brace for volatility. Stay the course. Don't change your long-term investment thesis. So again, any questions, any concerns, any feedback, positive or negative, I'd love to hear from you. Please do give us a call at 1-866-794-6065 or send us an email at strategycall@zackspro.com. All right, thanks everybody. Talk to you soon.